This is Elton Kane for Finextra at Sibos Sydney 2018, and I'm here with Marc Andrews, Vice President Watson Financial Services at IBM. Marc, thank you for joining me.
Thank you, Alan. It's a pleasure to be here.
Marc, how are banks coping with the regulatory burden at the moment and the pace of change?
Well, unfortunately, the only way for them to really address the increasing regulatory demands is by adding people, adding resources. Banks are getting stressed out by the increased regulatory requirements, especially around areas like money laundering, financial crimes, some of the new payment directives, a lot of the activities around monitoring trading activities, things of that nature. So they've been overburdened with the requirement to just add people because most of the processes today continue to be fairly manual.
We hear a lot about developments in artificial intelligence. How is this being applied and how is this relevant?
Banks have been looking to apply technology in increasing manners for a while now, and they're now hitting a tipping point where they're looking at how do they go beyond the legacy approaches that were largely rules-driven to generate more insights for the people that are having to deal with the regulatory requirements and to enable them to make better decisions and enable them to make those decisions faster. And in fact, that's really been the primary focus of artificial intelligence today, has been not as much around pure artificial intelligence and replacing the functions that the humans are doing, but how can we more provide augmented intelligence? How can we, one, generate insights from all the noise to help them make better decisions and make them faster? And also, how can we streamline some of the activities that they're having to do manually? One of the other things that we see as we look at the activities that banks are performing to actually address some of these various different requirements, many of them talk about how 50% of the time of the analyst is actually spent going out and trying to retrieve and pull information related to perform their task, whether it's looking at any money laundering alerts or fraud or other activities. And maybe 15 to 20% of their time is spent on doing the actual analysis and making the decision, and the rest of the time is actually spent on documenting their decision for audit and compliance purposes, because anytime they generate an alert, before they can even dismiss it, they have to document why they dismissed that alert, why they made those decisions. In fact, some of the banks we've heard spend more time documenting things that are false positives versus the actual suspicious activity. So there's a lot of opportunity here to automate some of those activities that are more focused on checking the box and documenting their actions, and enable them to spend more of their time on doing the actual analysis.
Okay, what about specific use cases? How is AI applied in solutions in areas like risk management, financial crime prevention?
So one of the areas where we see the most opportunity to apply artificial intelligence is in AML in particular, in anti-money laundering. And most of the systems that banks are using today are primarily driven by a set of rules that define certain types of transactions or activity that will generate an alert that requires them to look into if that customer is involved in money laundering activity. However, as a result of the current process, for every 100 alerts generated, maybe one or two result in something that they actually take to the point of filing a suspicious activity report or a SAR. So for every 100 things they're looking at, 98 of those are basically just noise that they have to deal with. And this is a great opportunity to apply artificial intelligence and machine learning and cognitive technology to generate insights about those alerts and go beyond the traditional rules-based approach. So as an example, one of the things that we're doing is looking at the behaviors of the customers themselves beyond just their standard demographics, going beyond looking at the individual transaction, but all the activity that the customer is engaged in, the counterparties that they're interacting with, and identify the behaviors that are correlated with the individuals who end up having their alerts escalated. And in some of our initial pilots, we found tremendous success in this space. So for example, at one bank, we were able to identify characteristics of customers. We were able to dynamically segment the customers and identify 6 segments of customers where not a single alert was ever escalated. So they could all of a sudden identify those as lower risk customers. At the same time, we were able to identify the higher risk customers. We in fact found 3 segments of customers, a set of related behaviors, where customers that behaved in that manner had anywhere from 20 to 25% of their alerts escalated. And that they're able to now more quickly get to the higher risk alerts and focus on finding the potential financial crime versus just clearing off the noise.
Sounds like some valuable results there. Thanks very much for your time.
Thank you.
And thank you for watching.